EPK Capital presents Daily Brief 13 September 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your AI host, Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Let's start with the major stock indices and their closing levels. The S&P 500 finished at 6,584.29, down just 3.18 points or 0.05%. This marginal decline came after the index had reached record highs earlier in the week. The Dow Jones Industrial Average experienced more significant pressure, falling 273.78 points or 0.59% to close at 45,134.22. This represents the blue chip index's largest single-day point decline in recent sessions. In contrast, the tech-heavy Nasdaq Composite bucked the trend, gaining 98.03 points or 0.44% to end at 22,141.10. The Nasdaq's strength was primarily driven by major technology stocks, with the index actually hitting fresh record highs during Friday's session. Looking at international markets, Asian indices showed mixed performance. The Shanghai Composite had no trading due to local holidays, while the Hang Seng Index also remained closed. The Nikkei 225 in Japan closed at 44,768.12, up 395.62 points, or 0.89%. European markets displayed varied results. The German DAX closed virtually unchanged at 23,098.15, down just 550 points or 0.02%. The FTSE 100 in London fell 14.29 points or 0.15% to 9,183.29, while the French CAC 40 managed a modest gain of 1.72 points or 0.02% to close at 7,125.4. Despite the mixed daily performance, all three major U.S. indices posted weekly gains. The S&P 500 gained 1.6% for the week, marking its best performance since early August. The Nasdaq rose 2% weekly, while the Dow advanced 1.1%, posting its first weekly gain in 3 sessions. Federal Reserve rate cut expectations. The dominant narrative driving markets remains expectations for the Federal Reserve's upcoming policy meeting on September 16-17. Current market pricing shows a 95% probability of a 25 basis point rate cut, with just a 5% chance of a larger 50 basis point reduction. This near certainty of rate cuts follows a series of economic data points that have shifted Fed policy expectations dramatically. According to a Reuters poll of 107 economists, nearly all expect the Fed to cut its key interest rate by 25 basis points on September 17th. This would mark the Fed's first rate cut of the year and bring the federal funds rate to a range of 4,0 to 4.25%. The shift in expectations has been driven primarily by labor market weaknesses rather than inflation concerns. Fed Chair Jerome Powell signaled at the Jackson Hole Symposium that rate cuts could begin in September, citing rising labor market risks while warning that inflation continues to pose challenges. Major investment banks have revised their forecasts accordingly. Both Morgan Stanley and Deutsche Bank now expect the Fed to deliver rate cuts at all 3 remaining meetings this year: September, October, and December. Morgan Stanley suggests the Fed may implement 4 consecutive 25 basis point cuts starting next week, extending through January 2026. Inflation data complicates Fed Path. Thursday's inflation report added complexity to the Fed's decision-making process. The Consumer Price Index rose 2.9% year-over-year in August, up from July's 2.7% and matching economist expectations. This represents the highest inflation reading since January. On a monthly basis, prices increased 0.4%, above the forecasted 0.3%, and marking the largest monthly increase since January. Core inflation, excluding volatile food and energy prices, remained steady at 3.1% annually, consistent with July's reading and matching predictions. The inflation pickup was driven by several factors. Food prices accelerated to 3.2% from 2.9% in July, while used car and truck prices surged 6.0% compared to 4.8% previously. Energy costs increased for the first time in 7 months, rising 0.2% after declining 1.6% in July. Despite the uptick in headline inflation, markets appear to be focusing more on labor market deterioration when adjusting rate expectations. Recent jobless claims data showed unemployment benefit filings reaching their highest level since October 2021, underscoring growing weakness in the job market. Individual stock movements. Several individual stocks made significant moves that warrant attention. Tesla shares surged 7.4% on Friday, building on strong gains from the previous session. The rally was driven by expectations of Fed rate cuts, which typically benefit growth stocks. CEO Elon Musk has indicated that Tesla's humanoid robot venture, Optimus, could eventually represent a significant portion of the company's value. Warner Bros. Discovery continued its impressive rally, gaining 16.7% for the second consecutive day. The surge followed announcements that competitor Paramount Global is contemplating a cash acquisition offer, with Paramount stock also rising 7.6% on Friday. Micron Technology extended its strong performance, climbing 4.4% on Friday to achieve an all-time closing high. The semiconductor company benefited from an increased price target from Citi analysts, who noted robust demand for Micron's memory chips, particularly related to artificial intelligence applications. On the downside, Oracle faced significant pressure despite recent AI-related optimism. The enterprise software company's stock movements reflected mixed earnings results and shifting sentiment around cloud infrastructure growth prospects. Bond markets and treasury yields. The bond market provided crucial insights into investor sentiment and Fed expectations. The 10-year Treasury yield rose to 4.06%, up from 4.01% the previous session. This increase came despite the near certainty of Fed rate cuts, suggesting investors are factoring in longer-term inflation concerns. The 2-year Treasury yield, more sensitive to Fed policy changes, reached 3.56%. The 30-year Treasury yield climbed to 4.68%. The yield curve movements reflect the complex balance between near-term easing expectations and longer-term economic uncertainties. Yields climbed across the curve on Friday, led by the 20-year and 30-year maturities. This pattern suggests that while markets expect near-term rate cuts, concerns about longer-term inflation and fiscal policy continue to influence longer-dated securities. Currency markets. The U.S. dollar index, DXY, steadied near 97.6 on Friday, but remained under pressure as inflation data came in line with expectations. The dollar has weakened 0.24% over the past month and is down 3.46% over the last 12 months. The dollar's weakness reflects growing confidence in Fed rate cuts, which typically reduce the currency's appeal to international investors. John Velis, America's macro strategist at BNY, noted that the broader picture is still quite negative for the dollar on a variety of measures. Policy developments also influenced currency markets. The U.S. and Japan issued a joint statement emphasizing that exchange rates should remain market-driven and that excessive volatility is undesirable. This statement came as the dollar traded at 147.53 yen, rising for 3 straight weeks. Commodity markets displayed mixed performance with notable movements in energy and precious metals. Brent crude oil gained 0.99% to $66.89 per barrel, while West Texas Intermediate crude rose 0.41% to $62.55 per barrel. Oil prices benefited from geopolitical tensions, particularly a Ukrainian drone attack that suspended oil loading operations at Russia's Primorsk port. However, gains were limited by concerns about U.S. demand following weak economic data and expectations of increased global supply. The International Energy Agency projected an even larger record oil surplus in the coming year, citing ongoing production increases by OPEC+ nations and growing supply from competing sources. This oversupply concern weighed on prices despite geopolitical tensions. Gold continued its remarkable rally, reaching $3,642 per ounce, up 0.29% for the session. The precious metal traded near its all-time high of $3,675 hit earlier in the week and is on track for its fourth consecutive weekly gain. Gold has surged 8.52% over the past month and is up an impressive 41.26% year over year. The gold rally reflects multiple factors: expectations of Fed rate cuts, which reduce the opportunity cost of holding non-yielding assets, safe haven demand amid geopolitical uncertainties, and concerns about longer-term inflation trends. Market volatility. The CBOE Volatility Index, VX, stood at 1476, up slightly from 1471 the previous session. This relatively low reading suggests that despite various uncertainties, investors remain relatively complacent about near-term market risks. The VIX has declined 13.53% compared to 1 year ago, reflecting improved market confidence despite ongoing economic uncertainties. The low volatility environment has supported risk asset performance throughout 2025. Cryptocurrency market developments. The cryptocurrency market experienced significant developments worth noting. Bitcoin held above $115,000, with the total crypto market capitalization approaching $4 trillion. Ethereum traded near $4,018, up from recent support levels. A major development was the anticipated launch of the Dogecoin ETF, originally scheduled for September 13th, but reportedly delayed according to some sources. This development highlights the continued institutional adoption of cryptocurrency products. The crypto market received additional support from regulatory clarity, with the SEC announcing Project Crypto, a new framework covering tokenization and stablecoins. This regulatory progress has improved sentiment around the industry's long-term prospects. Institutional participation continued to drive crypto markets higher, with exchange-traded funds focused on digital assets seeing $757 million in inflows over 24 hours. BlackRock's Bitcoin ETF received regulatory approval in Europe, signaling growing mainstream financial adoption. Global economic developments. International economic data provided mixed signals about global growth prospects. The UK economy stalled in July, showing zero growth month over month after expanding 0.4% in June. Services output grew modestly by 0.1%, but this was offset by a significant 0.9% decline in production, with manufacturing falling 1.3%. European Central Bank projections suggested continued below-trend growth for the euro area, tracking around 1% in both 2025 and 2026. The ECB held its deposit facility rate steady at 2% at its September meeting, with expectations for just one more rate cut in this cycle. China's economic data continued to show challenges, with recent reports indicating factory output and retail sales growth slumping in recent months. China's GDP growth forecast has been reduced to 4.6% for 2025, falling short of the official target and down from last year's 5.0%. Geopolitical developments. Several significant geopolitical events influenced market sentiment throughout the week. Most notably, Israel's airstrike targeting Hamas leaders in Qatar drew widespread international condemnation and complicated Middle East peace negotiations. President Trump expressed displeasure with the Israeli action, stating he was very unhappy about the strike and promising a detailed statement. The attack has potentially jeopardized ceasefire discussions that Qatar has been facilitating between Hamas and Israel. European leaders demonstrated unprecedented unity in response to Russia's continuing aggression, despite facing domestic political challenges. Poland shot down Russian drones that had entered its airspace, marking the most far-reaching intrusion ever into NATO territory. The geopolitical tensions have contributed to safe haven flows into assets like gold and U.S. Treasuries, while also supporting energy prices amid supply disruption concerns. Corporate developments. Several significant corporate developments shaped individual stock performance. Figure Technology was valued at $7.6 billion after its shares jumped 44% in their NASDAQ debut on Thursday. This strong performance added to a run of successful first-day performances by crypto-linked firms. The blockchain lending company's successful public offering reflects growing mainstream acceptance of cryptocurrency-related businesses and suggests continued investor appetite for digital asset exposure through traditional equity markets. Other notable corporate news included continued strength in the artificial intelligence sector, with companies like Micron Technology benefiting from robust demand for AI-related semiconductor products. Sector performance analysis. Technology stocks led market performance, with the sector benefiting from both AI optimism and expectations of lower interest rates. Consumer discretionary stocks also outperformed, supported by companies like Tesla and Warner Brothers. Discovery. Materials and healthcare sectors lagged the broader market, reflecting concerns about economic growth and the impact of potential trade policy changes. Financial stocks showed mixed performance as investors weighed the impact of expected rate cuts against improving economic conditions. Looking ahead, as we look toward next week, the Federal Reserve's policy decision on September 17th will undoubtedly be the primary market focus. While a 25 basis point cut appears nearly certain, investors will closely scrutinize the Fed's dot plot projections and Chair Powell's press conference for guidance on the pace of future easing. The Fed's summary of economic projections will provide crucial insights into policymakers' evolving views on growth, inflation, and employment. Any signals about the terminal rate or the total number of expected cuts could significantly impact market positioning. Beyond the Fed decision, investors will continue monitoring inflation trends, labor market developments, and geopolitical situations that could influence market sentiment. The ongoing situation in the Middle East, US-China trade relations, and European political developments all remain key variables. Economic data releases will maintain their importance, particularly employment reports and inflation readings that could alter the Fed's policy trajectory. Corporate earnings season will also provide insights into how companies are navigating the current economic environment. Key market levels to watch for the S&P 500. The index continues to trade near record levels, with support around 6,580 and resistance at previous highs near 6,600. The index's ability to hold current levels amid Fed uncertainty will be crucial for maintaining bullish momentum. The Nasdaq's outperformance suggests continued technology sector strength, with key support around 22,000 and potential for further gains if rate cuts proceed as expected. The Dow's underperformance reflects concerns about economic growth affecting more cyclical components. In bond markets, the 10-year Treasury yields movement above 4%, despite rate cut expectations, suggests investors remain cautious about longer-term inflation risks. A break below 4% could signal renewed confidence in the Fed's inflation-fighting progress. Conclusion: September 13, 2025, represented a day of careful positioning as markets prepared for the Federal Reserve's pivotal policy decision. While stock markets showed mixed performance, the underlying themes of Fed easing expectations, persistent inflation concerns, and geopolitical uncertainties continued to drive investor sentiment. The combination of near-record stock prices, elevated gold levels, and relatively low volatility suggests markets are cautiously optimistic about the Fed's ability to engineer a soft landing for the economy. However, the complexity of current economic conditions, with sticky inflation alongside labor market weakness, presents challenges for policymakers and investors alike. Next week's Fed decision will likely set the tone for markets through the remainder of 2025. Investors should prepare for potential volatility as markets digest not just the rate decision itself, but the Fed's communication about the path ahead. The interplay between domestic monetary policy, international economic developments, and ongoing geopolitical tensions will continue to create a complex environment for market participants. Success in this environment will require careful attention to data, nimble positioning, and recognition that market conditions can change rapidly. As always, investors should maintain diversified portfolios and avoid making dramatic changes based on short-term market movements. The current environment reinforces the importance of long-term investment planning while remaining responsive to changing economic conditions. That's your comprehensive market wrap for September 13th, 2025. Stay tuned for tomorrow's analysis as we continue tracking these critical market developments. Thank you for watching, and remember to subscribe for daily market updates and analysis.